Good afternoon, everybody. Welcome to the Tuesday, July 12th edition of Bull Sessions. My name is Mark Robertson. I am joined here by Sean Mace, one of our.
Hello there.
How's everything? Are you still in Pennsylvania now? Or are you not
We
heading?
we won't be heading out till looks like Monday morning. We'll be heading out to Arkansas.
Cool. Well, it look like some very
So
interesting places in Arkansas. It's been a while since I've been there, and of course, we actually traveled through there recently.
they've got an opened public diamond mine there, just an hour from where we're staying at. So we'll definitely be stopping by, and hopefully we'll get some good diamonds out of it.
Cool. Well,
Kids can find some.
keep your eye out for Bucky's. There's a place to stop. Bucky's Rest Area, 100 gas pumps. Like you won't
Easily,
believe.
I've seen
All
them
right.
all over the country when I drive.
All right, Ken is somewhere traversing a highway, so he won't be able to join us today, and Kim is also detained, so it's the two of us, and we're just going to cover a few basic things. Again, the reminder on the cover slide is just a couple of things. That's basically a tip of the hat to Ernest Hemingway's book. The stock market also rises, and it's just our annual reminder with the running of the bulls. As difficult as it might be to believe, I think most everybody here has considerable faith that pick a great company at a good price and ultimately will work in your favor. So we will continue to hope for the best. Grab something here. Okay. Morgan Freeman is just a reminder about the considerable power we seem to be unleashing with some of our data in the database and that kind of stuff. We're going to go through some quick screening demonstrations, and I will encourage you to tinker on your own. I know some of you already have, because I've already received considerable correspondence about what you see as the possibilities there, and we greatly appreciate that. Our small companies are still a little bit grumpy, but they seem to be improving also, but it is still quite the bear market when it comes to those small growth companies. So let's go ahead and get underway. Here's our standard disclaimer. No investment recommendation is intended. This is all about the demonstration of something that many of us have been doing for a number of decades. And in fact, the modern investment club movement dates back to the 1940s. And really, it is a reminder to find excellent companies at good prices and just continue to hang on to them. Get a little background noise, Sean. Are you
I apologize.
okay? Yeah, just go ahead and unmute yourself if you have anything you want to say. So everything here is to basically illustrate and demonstrate those methods and techniques. And there's been considerable success in this community based on some of those practices. So please do your own homework. And if we do own something, we'll try to remember to disclose that. We do have a monthly webcast called the Roundtable. That is coming up on the last Tuesday of this month. It will be our 12th birthday, beginning our 13th year. And we're having a heck of a good time there, about a 16% annualized rate of return. If you'd like to have just a brief reminder as that date approaches, you can be added to an email reminder list by sending a note to ncavula1@comcast.net, as shown right here. And Natalie will fix you up. She will not inundate you with email. She will basically just provide you with a nudge anytime that is coming down the pike. If you have any questions or suggestions for future topics, you can write to either Ken or myself at those two email addresses at the bottom, mark@manifestinvesting.com and kcabula1@comcast.net. All right. Here's a quick reminder about how challenging it's been this year. I mean, it figures the year that I go with some NASDAQ or QQQ-based investments in my Groundhog portfolio, we end up with this. So you guys can all blame me. The NASDAQ composite is actually having one of its worst years, at least first 6 months, in quite some time, if ever. And we have to just simply hope that we get some recovery in the second half. Now, many of those companies are becoming seemingly quite undervalued. and attractive, the Googles of the world and some of those. So we would encourage everybody out there to take a closer look, and I'll hope for the best. Kathy Wood and I are having a tough time in the Groundhog, and this is the primary driver of that. So let me check and see if we've got any other commentary that you guys would like to talk about. Okay. Thanks, Len, for the tip there. In fact, Len, I think I'll just move you into the back room in case you've got anything on your mind. So, Len, you're back there if you want to pitch in. And
Well, hello, Mark.
how are you doing, sir?
I'm doing good. Let me look and see.
Yeah, just check in on that because I wasn't able to see where I could promote Sean at all. So take a look at that. And while you're doing that, some of the guys I track actually talk about the subject of chart crimes. And this is one that I thought I would throw up because I'm not sure I understand this. The author was basically trying to make the point that the stock market was considerably overvalued and was suggesting that those lines should converge on each other. And I'm not buying it. I read the article a couple of times, tried to figure out what in the world they were talking about. I mean, U.S. GDP, gross domestic product growth, in good times grows between 3 and 5%, leaning more towards that 3% number. And the household and nonprofit net worth grows at somewhere between 6 and 10%, in many cases hovering around 8%. I don't see any way those lines are ever going to come together. And it's just something that I kind of scratch my head about and toss it out there as a potential chart crime. All right. Here's one we haven't looked at in a while. There's a lot of question about potential recession kicking around with all the inflation stuff that's going on and the economic disruptions going on. What we like to do is basically strip down the database into the value line industrial. So this is going to be all companies in the value line investment survey, and we strip out the banks and insurance companies and that kind of stuff, the financials, and look simply at the industrials so we can look at their profitability as measured by percent net margin. And I would draw your attention to, here's what happened with COVID. This was quite the nasty shutdown related moment, but we are having a moment with all that's going on right now with, again, the economic disruptions that we are finding a little bit of a tick down. And again, what happens in a traditional recession or a conventional recession is that basically profit margins get squeezed and in some cases approach low single digits. And of course, that means since that's an average, that means that some companies actually dip into negative earnings. And in fact, some companies under those conditions actually cease to exist from the planet. If you've actually been an owner of one of those situations, and I've had a couple over the years, it's not a pleasant situation when the tide goes out, you find out who's swimming naked, and basically have that situation. Now, the 2022 numbers, the projections for the end of the year are weak, but they're not staggeringly weak. And that's basically what you're looking at there. And again, the optimism that we perpetually see from not just Value Line, but analysts in general, the message there is basically get out there and find great companies at good prices and hope to end up on the positive side of that situation. So again, not alarming recession type warnings here yet. And I don't care what type of numerical definitions they slap on it. What really matters is when our stock selection guides and our stock studies begin to be compromised and fall apart because of the compression of margins for companies. That's when a recession actually becomes real. Or, of course, when it becomes hard to put food on the table and that sort of stuff too. But from an investing standpoint, this is kind of the thing to key in on and be aware of. All right. What I thought we might do for a few minutes is just spend some time talking about, again, this slide we put up every week. I just wanted to embed the version of it that is online at Manifest Investing. We've basically converted The newsletter had been a monthly. It had been on a kind of an intermittent hiatus, and we're kind of bringing it back and talking about stuff on a more weekly basis. I thought I would just run through and show some of the features because I discovered in some conversations with people here recently that they weren't aware of some of the stuff that's actually embedded in this every week. So let me go ahead and jump out to the actual website. Just going to manifestinvesting.com. And what I want to do is just kind of drill into this. It's always going to be every week, it's going to be near the top of the page. And there's the page we were just looking at. Let me go ahead and bump this up so we can see it just a little bit better. Okay, so you've got the expected returns there. And again, here's our chart. As we pointed out last week, we are into a situation where we do have white space below the blue line. So again, no big surprise there. It's just, again, a reminder that there's a few more companies on sale these days. We do see projected returns in the 15 to 16% range for the first time in several years. So again, it's kind of encouraging to get out there and go shopping. The actual average right now is 15, as you can see right down there, down the middle of the page. So that's the average median projection. And what I thought we would do is just kind of go down the page and take a look at this. Obviously, this bull session that we're at is right here. But one of the things that I wanted to point out is we'll come back to this and actually look at screening, but the triple play is available in the manifest screen. So we'll come back and take a quick look at that. But underneath the every week we actually go through the companies that are in the roundtable or in the manifest 40 and actually give links to a fairly quick analysis. Many times we'll put the value line close here and actually take a look at the business model analysis as we've referred to it. As many of you have suspected for a long time, this is kind of a prototype for what's going to end up on our company research pages for all companies. And again, you get a pretty good breakdown of what's going on in a company like Pepsi. Now, they did report earnings. I did not get a chance to check it either last night or this morning, but that is out there right now for Pepsi. But they have been pretty much firing on all cylinders, as you can tell by looking at the operating margin and the net margins. And we see basically mid to upper single-digit returns, so definitely solid holds if you're already a shareholder in Pepsi. See right near the middle of their price range, fairly decent long-term price forecast, but again, nothing that's a screaming buy in any case. You can see the Morningstar actually considers them to be basically fairly valued at those current levels around $170. So that's just an example of one of the companies. Another one here, and this one will shake Sean loose. Boston Beer is in the roundtable. It was featured as a featured company a few months ago, and I know that Sean presented that to his chapter this weekend and got a little bit of a lukewarm reception. But I mean, this company is down from a high price, considerably higher than it is right now. I did notice that Value Line did make some fairly substantial reductions. They did reduce the financial strength rating, which is not something they do very often. They dropped the long-term low price forecast from 670 to 480, and a little disturbing to see them. And they might be inordinately pessimistic here. You can see the company has been a little bit bumpy over the years, had a bit of a flat spot a few years ago. Of course, 2021, in combination with COVID, was that inventory challenge that they have with their Truly, their seltzer drinks. And hopefully they'll come out of it and do just fine. But it is a little bit troubling to see the expectations knocked down here a little bit on the far right. And you can see it just kind of weakened the overall picture. I continue to hold great expectations for this company. I think that the rhinos, the analysts following the company that are looking at the 2022 to the 2024 picture here, both with respect to sales and earnings, actually continue fairly strong. Again, treating that 2021 situation as a bit of an outlier.
So I think this is one of those opportunities where you take Warren Buffett's advice, and when there's blood in the streets, this might be a good time to pick it up while people think it's not looking good.
Yeah, I mean, they've stumbled considerably, but there's still considerable decent expectations here. I mean, when you look at they have no debt really to speak of. The low price, they're trading fairly close to their 52-week low. Now, Value Line did reduce their long-term forecast, which makes this a little more or a little less attractive. But look at the Morningstar fair value; they're still at 740. So they're basically saying this company is considerably on sale. So it's going to be interesting to see who wins in the tug of war with the rhinos. And I guess I kind of take a step back from the forest and look at the situation and say, look, these guys have been doing pretty good things for quite some time. I am not oblivious to the fact that there's an enormous amount of competition for, bubbly beverages for adults out there, but that's always been true. I don't see that has increased significantly in any special way. So again, this is just something that you can get at from the homepage. Any other thoughts on this one, Sean?
Yeah, no, I don't think they'll be hitting their 1,200 year high anytime soon, but definitely a $600, $700 valuation I think would be rather fair. So picking them up now at the price they are, you're looking at 50 to at least 50% return hopefully in the next few years. But that's all my assumptions on this stuff, because I have a little bit more optimism in this yet. I guess I just haven't been knocked down a peg or two to be pessimistic yet.
Yeah, I think if they don't show some price recovery here fairly soon, we could actually be into a period of tax-related loss selling for income tax purposes, and that might actually prolong what I've come to know as an accumulation opportunity, an accumulation period, which could actually last several months now if they actually get into that season. So it's just something to think about. So again,
and I do know they wrote off over $200 million, I think, of worth of product last year, because that's how much they overproduced it by.
Yep. So just as a couple other quick examples, this is one of Kavula's favorites, Alimentación Couche-Tard, continues to look pretty good. And this company is, again, we're looking at mid-teens for the return forecasts here. The projected annual return at 14%. That is based on a growth forecast of about 8%, which is the red dotted line there. A projected net margin of approximately 6%. You can see that they've been hovering in that range, a little bit of snaking around there with the economic pressures that we've seen. Projected earnings in that $7 range 5 years from now. Keep in mind that's always going to be 5 years from now, anytime you see it on one of our pages. So again, a 14% return, which reconciles quite nicely with a projected return on value for the company. And again, not much debt. What little debt they have is at an interest rate of under 3%. So that suggests that the financial institutions have quite a bit of respect for these guys, trading near 20% of their 52-week low. And the low price forecast reconciles pretty nicely with these numbers up here. And a little bit discounted according to Morningstar. So again, a fairly decent situation, worth a closer look according to Robert Greene at Value Line. So maybe a little bit in the doldrums here over the next several months, again, as things shake out. Again, these guys are also the home of Circle K gas stations and convenience stores. So another one to look at there. And let's see, we'll take a quick look at Herb Lemkool's Tyson Foods. By the way, Herb picked this 7 years ago. Like I said here, a few of us were a bit skeptical at the time of the selection, but he is smiling, beating the market over those 7 years, which is really pretty cool for a company like Tyson. They've had a pretty good run, so they might be hovering a little bit here in the next few months to a year, but pretty good situation there. Also, you see low teens for return forecast, decent interest rate from the bank, trading down in their price range, and in general, again, not incredibly exciting in terms of running out there and shopping for a buy, unless Herb disagrees. And I would certainly listen to what he has to say. But these guys are actually doing fairly well as far as anticipating market needs and expanding, and apparently doing that in a very considered capital strategic framework. All right, so those are there. Pepsi's here also, like we said. The other thing that's here are these useful links, and it's just articles that I run into that might have some interest to investors in our community. This one here, if you haven't looked at it, you probably remembered if you've been in the community for quite a while. This one we actually celebrated quite a bit at the National Convention in Dallas last week, but this actually goes back to the late 1990s and Smart Money Magazine and Emily Harrison Ginsburg. It's Tom O'Hara there in the picture. But this is really kind of a delightful trip back through, see the Motley Fools there, through the community back in that time frame. And that was a large convention out in San Jose at the time. Picture of myself there with Tom and Cy Lynch, Nancy Isaacs, great contributor to the Better Investing magazine. So again, this is a really, it's a long read, but it's a fairly neat read. And there's Cy. Again, we're talking 20 years ago. So kind of fun. So that's an example of an article that's there. Another one that I would point out that goes pretty well with some of the stuff going on right now is this Get Rich Carefully book report that we had done a few years ago, actually about 7 years ago. This book surprised us at the time. And there's some really good stuff in here with respect to how to look at the overall economy. If you have any concerns personally about the stuff going on with dark pools and all the type of high frequency trading, that kind of stuff, he really tackles that quite well in the book. Would heartily encourage you to take a look at that. There was a portfolio here, but he goes through and talks about recessions and indicators, economic barometers, that sort of thing. And we'll actually publish an updated vertical version of this chart. Again, the employment picture is a big part of actually looking at what happens during recessions. This is some recession activity back here in the early 2000s. Here's the 2008, 2009. If you pull up a current version of this chart, you'll find that employment activity, all the indicators are actually quite positive. And I don't think we've ever had a really nasty recession anytime this one looks good. So again, you can take a look at Kramer's lessons about that, some more commentary on that, along with some other commentary. So again, the point being, these links can be a pretty interesting thing to check in on. Another good article there from Peter Lynch about if you're afraid of crashing, how do you actually regard that? So again, every week, these expected returns are going to show up and give you those hot links and a look at some of this type of stuff. All right. Along with the current earnings, as I said, Pepsi came in Monday night. There's some big ones coming up here on the financial side of the house here Thursday and Friday. Any other comments on that, Sean?
I've got nothing here.
Okay. All right. So let's go ahead and talk about the stock screen. I know many of you have been tinkering. I know that because you've written to me and talked about it a bit. Kurt has actually enabled some fairly interesting features, and we'll probably go through and do a complete workshop on this here fairly soon. We just did one with the North Florida chapter of Better Investing, so thank you guys. I know a few of you are on the call here also. But what's been added to the screening criteria is, first of all, the triple play, which we'll come back and demonstrate. The projected return on value is here, and you can actually screen on that. And again, that's going to run pretty much parallel in most cases to the projected annual return, that result showing Section 5 of a stock selection guide. Also added, this was not new, but it's there, the percent from 52-week low for doing a Hugh McManus type screen. Another thing that's been added, the RSI, Relative Strength Index, and what I'm going to need for you to do, at least for the for the near future is consider that to be a recent relative strength index. In other words, it's not changing daily for most companies, although we will be converting that to real time as soon as we do a little bit more tweaking. So you can actually search on relative strength index. Now that's going to be the conventional or traditional 14-day look back period. So that way we're basically looking at it the same way that most of the creatures on the street are looking at it. Whether that's right or wrong, that is how they look at it. That's how we would probably look at it. And it is the number that is widely published. The other item that we've got on here is if you're out there searching for core holdings for your portfolio, you can actually go in and enter 225 as the minimum value. And again, that is the combination of the quality, the financial strength, and the earnings per share stability. Those three adding up to form that 225. Some people probably think it should be 240. That's up to you. But we basically say that any company that has those three strong characteristics, basically in the excellent or very good range for any company, you can actually seek them out as core investments. So let's go ahead and demonstrate. Here's one that we actually published just the other day. You can just go ahead and say, show me the triple play candidates. You just click that. You don't have to click anything else. Just hit search. And the companies that come up are companies that are candidates. Now, that's not perfect, but we're basically asking three questions. Is the return forecast elevated? In other words, is the current price basically crushed from where it's been in the recent past? And then we also ask the question, is the projected profitability greater than the current profitability? And is the current PE less than the projected PE? And if all three of those conditions are met, and again, it can be very close statistically. It could be 10.1 versus 10.2. Sometimes it's not a big deal, but it's kind of a yes or no question. So in this case, these companies come up. What I love to do in this situation, because this is a long list, I think there's probably 100 companies here, thanks to the current bear market and recession. There's a bunch of companies here, just like George Nicholson told us during these times. So I'll just simply say, okay, just show me by ranking on the quality, just show me the ones that are most attractive. So in this case, Cy Lynch's nomination back in March or April for the roundtable of Littelfuse, and the audience actually voted for it also. They seconded his motion. This turns out to be a fairly decent company to look at. Other people have reported taking positions in Taiwan Semi. Now, the semiconductors have actually been sagging a little bit here recently, but there's some pretty good companies here at the top of the list. MKS has been really getting damaged price-wise, so you might want to dig in and look for root cause and all that kind of stuff with that particular company. Alphabet, Google is up at the top of the list. Both of those two classes of stock near the top of the list. So again, all we looked at here was triple play. That's the only thing that we basically looked at and hunted for them based on highest quality. Now for kicks, if you want to set your hair on fire a little bit, you could click on projected annual return. And again, this is going to show you some friskiness here. But as you work your way down this list looking for elevated returns, I would also want to have my attention drawn to the higher quality numbers here before I would stray into this too good to be true or danger zone, if you want to think of it that way. But for some of these companies with the higher quality ratings, could be a good study. I mean, Green Brick, Steel Dynamics has been good to my Groundhog portfolio, if nothing else. And you just basically see some fairly interesting things. So again, searching by highest quality is probably the safest place to go. Highest quality in combination with return forecasts could lead you to some fairly interesting areas. So back to the stock screen, we'll look at another one here. Again, demonstrating, we're in one of those moments that Nicholson taught us about. If you can find companies that have really been punished so that their relative strength index is underneath 30, you basically just enter that 30, and then we can enter in some other stuff to kind of trim. Let's say under 30, but I only want to deal with excellent companies. Don't want to get too frisky on the returns. let's go 17 and a half to 20, let's say 25. Let's limit the upside to 25. Just kind of see what happens. So excellent companies that are depressed in stock price. See what we get. And again, a fairly interesting list of companies. Again, limited to a 25% projected annual return on the upside. Siemens is a great study right now. Siemens would be the General Electric for the rest of the world. Siemens, ABB, and GE that run in that circle. Siemens happens to do a whole lot in the power industry and infrastructure type stuff in Europe, and they're heavily involved in rebuilding. If you haven't followed the news, Germany is really questioning some of their long-term strategies with respect to energy production, and have actually restarted a bunch of coal-fired power plants. So Siemens and ABB are going to benefit from that. And again, I don't think it's a long-term solution, but I think it's an intermediate thing that they need to do. So Siemens is going to probably do fairly well in that respect. A couple other companies on there that might be worth a closer look. Let's go back and just do a couple other real quickly. Again, if you're hard pressed to come up with companies that for your portfolio that you really need core investments right now, one of the things you might do is say, well, give me just sweet spot companies, and let's do a core score of at least 240. So 240 in the sweet spot. What happens? Again, many companies are going to show up on these multiple lists, qualifying in many different ways. But again, some fairly decent companies on this list. Generac shows up here. These are companies which could be considered core holdings would be considered core holdings by many of us that actually have decent return forecasts. So I would encourage you just to tinker around with the screens, and I'd love to hear from you if you have any questions about things or hints or tips. You can see Siemens is on this list. Ann Manning presented Align Technology in Dallas. And there's just a number of companies here that have been fairly good to our community over the last few years that qualify under that list. And again, all we're looking here for is a sweet spot, a return forecast that's in this range, and would qualify in most of our opinions or perspectives as core holdings. Any questions or comments, Sean or Len?
I think you got it all there, Mark. I'm really liking the intricacy that Manifest is now starting to show, so we can start doing some really good research.
Okay.
Yeah, Mark, this is Lynn. The one thing I would love to see in this is short interest.
Well, we actually have that as one of the parameters that we track. I'll take a look at adding that, Len.
Okay.
Yeah, not a problem. Take a look at adding it.
Cover might be a more useful metric because then it takes into account the current volume.
Right. I know that the one that we have is percent of shares outstanding that are short. I mean, we have that for sure. Yeah. I'd have to dig a little bit deeper to see what other data we might be able to access, and then you'll have to do the workshop on what you're looking at and how you would actually use that ferret out opportunity. Now, I know Sean has done some work with GameStop and companies like that when they get into the short selling circus.
Mm-hmm.
All right. Let's go ahead and come back to our traditional areas where we stop. Couple of things here. This is the current Groundhog. I find it fascinating that we have 166 entries. Not a single one of them is still above $1 million. Even the celebrity Groundhog up at the top, David Einhorn, has dipped below $1 million that we all started with. And a bunch of familiar names up at the top. North Texas and the Bermuda Triangle Club out of Florida is actually creeping up a bit. Ken would rejoice that the monkey's down to 25th now. We'll just notice that and not belabor the point too much. Ken has made the list at number 40, Size at number 32, and Sean is at number 5. So, full speed ahead, guys. I do want to point out that Kathy and I are getting hot. She's up to 163rd, and I've actually pulled up a few places from near the bottom. We do have a few more people beating the market. I'd like to see that number come up also, and we're doing a little bit better collectively, but there's obviously some room for improvement. All right. Here's one of those crazy situations that we have talked about with that tequila transaction here over the last several months, and I just bring this one up to point out a 5-year look at this QQQ-based investment. I would call it a speculation. But one of the reasons I wanted to bring this up, just to underscore a point that I made, is I'm intrigued by the uptick in volume that we've seen here lately, along with the price coming down here, and this is where we've been dabbling with that unconventional transaction. I just wanted to point out the only time that's had higher volume in the last 5 years goes back to the COVID moment back in March of 2020. So again, the volume has been returning a little bit. Again, that actually bodes fairly well for the QQQ type stocks, possibly. We'll get some institutional interest in them. And I would encourage shopping and studying carefully for opportunity in those QQQ NASDAQ 100 stocks. All right, quick moment with our best small companies. Story is pretty much unchanged. We're still in a bear market pretty much across the board, although the Wilshire 5000, as measured here by the VTI, has snuck up above $1,600. And we started with $2,000 back in Halloween, so that actually has crept up out of the bearish zone. But this one is still deep in the bear zone. And again, our active portfolios outperforming our traditional buy and hold, although there's going to be an interesting update to that this afternoon. But from top to bottom, seeing general improvement. I do think that this $100 difference is definitely something that we can overcome. Just have to keep hoping, and the stocks that we have selected lately, like InMode and a couple others, well, of course, Pachira, have actually been performing fairly well, and I continue to hold out hope for Boston Beer and a couple of those at the bottom. I would definitely shop. Marie Frank did bring to our attention some angst with some issues at Fulgent that you might want to dig into in the forum and take a closer look. And of course, the news flash from today is this one. A company that we'd actually sold from the active portfolio fairly recently at a painful price of $3.46. Again, fairly recently, within the last month, and received an offer today of $8.75 a share from this company on a buyout. So hence, the active and traditional are running together now as of that transaction. And so it's good news and bad news, I guess. The bad news is we had sold it from the active portfolio, but it's still in the traditional, so it helped there. So those two are actually tracking together as of that transaction. So again, 346 offered 875. That's a pretty good bump up, considering what's been going on with that particular company. All right. Quick reminder, tomorrow afternoon, Brian Feraldi and Brian Stoppel will be doing their thing on valuation metrics over companies' life cycles. And again, this point being that different metrics apply to different parts of the growth cycle. And I will be tuning in on that, and we'll probably have a bit of a book report next Tuesday. And again, that's just your quick reminder that this is the way that the Bryans look at company life cycles. And Ken's favorite thing to point out is the fact that This one in the middle, first of all, you're not guaranteed obsolescence for any company. Hershey's comes to mind as a company that's probably going to float along up here. But there are companies that have a very long life cycle. And just a few things to keep in mind there. But again, thinking through the company's life cycle in stages as to what actually is the most useful way to look at it. All right. So with that, here's your quick reminder that we do archive all of these presentations, including the bull sessions. Sean contributes to his quick analysis shorts on the YouTube page also. We also archive all of the roundtables. You see our city slickers from the Dallas timeframe and Tom Cruise and our session from May displayed on the screen there, along with any other educational sessions that we may choose to put together. If you haven't subscribed, we would greatly appreciate it if you would visit it. All you got to do is go to YouTube, search for Manifest Investing, find this page, and click on the red button to help us get up over the hump with respect to subscribers. We will stick around for some questions. I basically go open microphone here in a few minutes. And here's just a reminder of how much damage those bulls can do running through the streets of Pamplona. So with that, I think I'm going to shut down the broadcast, but I will stick around if anybody has any questions.